Hi, I'm Lyn Adams.
I'm Justin Gross.
Hey, welcome to our first edition of Video Insight for 2019. This is our first quarter conference call. We're going to be talking about the market returns. We're going to talk about our portfolios and give you a little bit of direction as to what we see coming up for this year and next. All right. It's important that we let you know that everything in this call is for educational purposes only. Nothing in this call is intended to be investment advice, and for specifics around your situation, please give us a call or check with your advisor or CPA. All right, well, let's start with a look back at 2018. We had a pretty decent start to 18. Into first quarter, we had some slowdowns abroad. By second quarter, Trump was talking about tariffs. Second quarter, a lot of sell-offs overseas. By the end of the year, we had widespread sell-offs in all the stock sectors, and that brings us to a year-end set of data that looks like this. Pretty much everything is red. Interestingly, the bond market finished positive 0.01 only because all the money ran out of stocks in December and ran the bond market price back up over par because we did have interest rate challenges all year. So bonds were pretty much zero. Real estate was down 4. Large cap stocks in the U.S. were down about 4. Smaller cap stocks around -11. Commodities down -11. The EFI, which is the developed non-U.S. markets, finished down almost 14, and the developing markets down almost 14. So certainly not a good year for returns.
Yeah, we've listed the main ones here, but around the world, investable opportunities, I think 90+% were negative for the year. And then really taking a step back to 2017, where there was no volatility.
Right.
Right. So and then in 2018, you saw volatility, like you said, in January, February, then certainly later in the year. So
we want to take a little different spin on this conference call than we have in the past. We want to talk a little bit about our portfolios here. You know, I would love to tell you that we, beat the market to death on the upside and the downside, but 2018 for us was the first time we've really fully engaged our defined risk strategy. And as we had the opportunity to use it, I think the results that we got were mixed. I think that we would have liked to have had better returns in the third and fourth quarter than the market. But I want to walk you through what happened and also talk to you about, still the pros and cons of why we do it. All right. So if you look at this slide here, these are our different portfolio models. We have 5 core models, and we have some other tactical pieces, but all the way from aggressive growth down to inflation protection are the models that we use for most of our clients. If you look at the 2018 returns, you can see that we were down anywhere from -7 down to -3, depending on how much risk you were taking. And of course, one thing that's important when we show you these returns is to realize that these aren't actual like mutual fund type returns. These are the averages for all of our clients in these portfolios, because you could take 5 different clients and get 5 different results, because you have some clients adding money on a regular basis. Some clients might have needed a check during the year, and we sold some stocks to get them money at some time. Others might have some protected positions. They got a position that's got a big time capital gain embedded in there. We don't want to sell it. So these are sort of the averages for our account returns. So don't focus so much on the return number, but the concept, all right? So in 18, let's use as an example the more aggressive growth strategy. It's lost 7%. Well, any aggressive growth diversified portfolio strategy in 2018 probably lost 7 or more, depending on how much international you had, how much reach you had, how much commodities you had. But our goal is to limit the downside. And so if you compare the 18 return to the prior year return, the 2017 return, which was a fantastic number, 18%, and you look at how much we were able to retain from the prior year, we still were able to retain almost 10%, right? And that's sort of what we try to do. We want to participate in the market when it's healthy, when it's more calm. We want to have the fruit from that, but we don't want to get stuck in one of these long-term, prolonged market declines and give it all back.
Yeah, and then this is a microcosm, I guess you could say, of bigger market cycles.
Right.
Because any investment is just a combination of risk and reward. Right. There's going to be good, there's going to be bad, there's going to be sideways.
Right.
Okay, and so we have to take all those into account. But being able to retain And then that's one of the key concepts of the defined risk strategy.
Right. So let me tell you a little bit more about this, so because there's, I think, a couple pieces that are worth understanding. The more conservative investors, folks that their goal is to beat inflation or maybe to have some balanced type income, in 2017, being able to produce double-digit returns, 11, 12, 13%, even total return up at 15%, that's not really a normal investment return for someone that has that little risk capacity, right? We're able to take more risk in a healthy market because we know we're going to hedge out. We're going to sell those stocks out when we get into unhealthy territory. So we were able to produce those higher returns in 17 for the more conservative investors. And then you can see that the losses are really muted for those investors because when the market got into that 200-day moving average territory and we started shifting out, they didn't take the same kind of hit as the more aggressive investors that leave more money in the stocks. So I think for our more conservative investors, you're probably pretty satisfied and feel okay with the results for the last 2 years. I mean, no one likes to lose money ever, right? Still lost 3% or 4% last 12 months. But if you understand, we get to participate at a really nice clip when things are going well, and we've got some floor in place when things are not so well. We have a lot of dry powder. I think most people understand that. I did want to point out the total return model, which we have a lot of people in, really underperformed, and it was an anomaly. We had a position in that account that for years we've used, produced good results, but when the monies in the bond market started shifting around sort of quickly in the later part of the year, that one really, we had to sell it because it was producing unfavorable results. So did lose about an extra % there than we would have expected. Let's flip over to this next slide and talk about the way these strategies are composed, right? Got some questions in the fall from some very intelligent clients that really didn't have full understanding, so it was really good. But we want to make everybody understand this. So imagine risk on. Everything is normal. There's no obvious challenges to the economy, to the markets. An aggressive growth strategy would have 90% in stocks. Total return would be like 60. Inflation protection closer to 30. Now that said, most inflation protection models would have 15. We take 30 because we know we can hedge out a lot of that risk if the market gets going in the wrong direction. But when we're risk off, meaning the dynamics in the market have shifted, things are getting uncertain, there's instability in the marketplace, and we shift out of stocks, then 45% would be what you're left with as an aggressive investor. A total return investor would be left with 20% in the market. So we don't take 100% of the stocks out. We only take the defined risk component out. So the box to the right is showing you in each of our strategies how much of that strategy is composed of defined risk assets.
Right. And it's a marriage and a blend of two separate simultaneous strategies. The defined risk, where we are trying to simply, there's two risks. There's the fear of losing money and there's the fear of missing out on making money. The defined risk strategy allows us to take more risk and hopefully capture those gains when the market is good and in a normal territory. But we also have, at all times, the more fundamental asset allocation side of the portfolio that there's going to be some exposure because you never want to be 0 or 100.
Right. We get the question sometimes, well, why wouldn't you just take all the money out? Like if you're risk off, take it all off, even if I'm an aggressive investor. Problem is, the results that you would create doing that are not consistent with what an aggressive investor is seeking to accomplish. An aggressive investor expects when the market goes down, they're going to be down more. When the market goes up, they expect to be up more. So they want to have more invested in stocks all the time than, say, in inflation. Someone that just wants to beat inflation, well, when the market's in negative territory or in uncertain territory, they don't want to own any stocks at all. So there's a range of each portfolio that has the defined risk component embedded in it. And we just wanted to show you this. And of course, the second slide on this is just basically pointing out that, hey, as of right now, and as of the date we put this presentation together, we're risk off on all our portfolios. So if you have the moderate growth strategy, you have 30% of your money in stocks right now, right? If things were, going well and it was global harmony and everything were stable, you'd have 75% in stocks. So you got to look at your strategy and realize how much you have in the market at this time.
And it's a communication thing, and that's why we're doing this. So when he said we are risk off, that does not mean if the market goes down, you will lose nothing.
Correct.
Right, because a part of the portfolio will be dedicated to stocks in most of these models.
Right. But what we can say is if the market went down 40% from here, which it has done in the past, in your, say, an inflation and protection strategy with 0 stocks, you wouldn't lose any money from the stock market in that portfolio because the inflation protection model doesn't have any stocks. But if you're a moderate growth investor and 30% of your money is still invested in stocks and it were to go down 40% from here, well, 40% of 30 would be minus 12 and you'd be down 12%, right? So it's just important that everybody understands that and that realize it's 2 strategies working together to marry into a really great overall diversification strategy. So this next slide is really to help illustrate the concept that this doesn't necessarily have a negative impact on you over the long run, because most of the time, in fact, about 80% of all months in the market for the last 10 years, the strategy is in risk on. There's no challenge to the market. The green bars on this chart, this is actually from our website, so if you wanted to read into it or look at it more, you can do that on the website. But we're in the market most of the time, and this defined risk strategy is running underneath it. So you get the upside of the market. It's only when we get below that 200-day moving average, and we actually have a range, we're going to talk about that in a moment, a trading range there, that we would come out and have that dry powder, have money that's not invested in stocks.
Yeah, we're going to be in the market more often than not because generally markets over time go up.
Right.
So, okay, so, but yeah, the dry powder, and we saw that in December. I'm sure we'll touch on that. But.
So this next slide, I want to really walk through, and again, this call may go a little longer than some of the others because this is really important to our practice, to our clients, that you understand it. So I want to talk about the primary cost of running this strategy. It's not an expensive strategy to run. You're not paying us a ton of money as an annual fee. You're not paying high transaction charges. The cost of this strategy is when you get gapped out. And this is a 12-month look back, 2018, of the market. The blue line is the 200-day moving average. The stock market trading range is above it. And you can see that when we got out to late October, we went below the 200-day moving average. The market did. Now, we set our sell limit triggers under the 200-day moving average because there's a lot of institutional buys that happen right at the 200-day moving average. If you look back to March and April, even in May, the market moved down to that 200-day moving average and it bounced very quickly off of that. There's a lot of program trades at the 200-day moving average. So our trigger is generally 2 to 3% below the 200-day moving average. It says, hey, when we get to that point, we're going to slide over to dry powder, right? So that occurred in late October. And then about a week later, the news was that President Trump was getting ready to ink a deal with China. The Fed was going to hold off on raising rates. There was a lot of optimism around that. The market rallied substantially around that news and went up to about 2% above the 200-day moving average. We do not re-enter at the 200-day moving average. We actually let it go up between 1.5% and 3%. We have a system for trading ranges, but we got out when the market was at 2720 or so, and we re-entered those stock pieces around 2800, right? So that hurt us because we were gapped out for that 80 points of return on the S&P 500, right? And then subsequent to that, we had decaying conditions. Trump didn't sign the deal, the market didn't like it, and we sold stocks again about 2 weeks later, and we've been out of stocks ever since. So the takeaway here is that the strategy is not designed for us to market time, get in, get out on whipsaw type environments. The strategy is very simple. We want to try to be out of this market when it is in uncertain territory, and we want to be in it for the longer period of times that it's in more stable territory. When you go through cycle change and the market's trying to decide, should it be priced at 2,800 or 2,600 and it bounces around, we want to stay out of that. So what actually happens in practical, in application is that if we get gapped out, we actually widen our trade windows so that we don't get gapped out over and over and over again, right? So if the market were to continue to be in this trading range, we would actually increase our trading envelope to something larger than it was initially, because we do not want to be -2, -4, -3, kind of paper cut to death in a short period of time. So fortunately, the market has decisively been negative since then, below the 200-day moving average, and we haven't got gapped out again. But when you look at our returns for 2018, that gap out that we experienced in November and October is actually a very significant contributing component between -1% to -3% of the actual returns that our investors got last year. And you have to realize it's the cost of the insurance, if you will. Like, we know that if the market were to go down 20, 30, 40 from here, that our clients would be very happy with what their net result is, because you wouldn't have the same exposure to the downside as the general market. But to have that strategy at work, the gap out is going to happen sometimes.
They're frustrating. I mean, but it's part of the strategy, and there is no perfect strategy. Okay?
Right.
But this is one that can succeed on both ends of the spectrum. If the market is going up in a progressive trend, you can capture that.
Right.
On the opposite side, like December, right? So we saw the market decline rapidly in December. This strategy protected you.
Right.
Well, you didn't like, and going even back to October at the highs, if the market and the trend gets higher above, that's going to be kind of the worst decline, because
Right.
you're above the moving average. So the gap outs, I guess the important thing here is that they're part of the strategy.
Right.
They're frustrating, but you saw a glimpse in December of why you put up with it.
Yep.
Okay, and if that were to continue from here, you'd really like those assets that are in the defined risk strategy.
And it's noteworthy, in 2015, when we hedged out, we re-entered at the same price, once even below what we got out at. So sometimes it can work in your favor. It's not always going to be a cost. Sometimes it's actually going to be a positive. But it depends on how long the market goes below its 200-day moving average, so that the 200-day moving average can follow the market down. And if we re-enter at a lower price than we got out, then everybody wins. But that does not always happen. Statistically, it's 50-50, right? Okay, so it's really important that everybody understand that's the strategy at work, that's where we're at, that's the returns for the market and our strategies for last year.
Keep in mind that while diversification may help reduce volatility and risk, it does not guarantee future performance.
The views are those of Adams Financial and should not be construed as investment advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. All economic and performance information is historical and not indicative of future results. Please consult your financial advisor for more information. The S&P 500 Index is an unmanaged index representing the largest 500 companies in the U.S. The Barclays Aggregate Index is an unmanaged index representing the overall broad bond market. Investors cannot invest directly in indices. The performance of any index is not indicative of the performance of any investment and does not take into account the effects of inflation and the fees and expenses associated with investing. Past performance does not guarantee future results.